I look closely at the participation rate because that's where the Fed has been wrong, right? Their expectation of inflation is backward looking based on the unemployment rate being below their long term, and participation keeps going up, and they've missed that the inflation pressures are less than they think, and today's blockbuster participation rate shows that again.
Kate, focus on the labor market participation rate because it kind of allows for the market to look beyond the strong headline number on some level.
Yeah.
Also perhaps allows Chairman Powell today to kind of put this in some context, this number, right? Not to say, first of all, you're going to be able to write, it's so strong, you're going to say there's got to be some kind of 1 month effect in here. It's not the going run rate. But also you can remain data dependent because, hey, maybe even though we got a hot wage number, we have more people coming in. The labor market's not as tight as we thought before.
Well, so look, I was really focused on the wage number coming into today, in part because after the weak ISM and some of those weak CFO surveys and the guidance we were getting before the earnings season, people were getting really anxious. And the consumer is a key part of the we're going to continue to expand, albeit at a slower pace this year theory and view that we have at Blackrock. And if the consumer was falling apart, the labor market started to soften, if wages were not as strong, I think that would be another shock to the equity market sentiment and would be really tough for investors who are really scared about putting on risk. This number, the 0.4 a month over month, and we're at 3.2 year over year, that's a good number. We want consumers to be able to spend, but I still do want the Fed to give us this message, and Powell today as well to give us this message, and next week when he speaks, data dependent, we're not going to tighten such that we really curtail what is a decent and long expansion.
But the participation rate, that could make it a whole new ballgame, and it's so good. It's so, I mean, that gives us some slack. But if you go back to the dual mandate, okay, they're satisfying so well the prosperity dual mandate, the full employment. Take a victory lap. You're satisfying that. Now, on the other side, if the participation rate allows you to worry less about the price stability mandate, then don't worry about that right now. I just don't see why we the market's hanging in there okay, but the specter of a 312 number just sounds like, oh my God. And first thing you think of, they're going to go back to the Phillips curve analysis and say, oh, we have to raise because obviously it's just almost it's almost knee-jerk, isn't it, that they have to? But if the participation rate can rise, they may not have to, right?
Yeah, well, just remember what caused that first sell-off in 2018. It was that payroll report with wages moving higher than the market.
Which is also what we want, though. But which is also
last February. One good bit of data, actually, is that auto sales, which everyone thought was going to, start tumbling, actually held up and actually was more than the market had expected.
It was up 1% for the fourth.
Exactly.
Up for the fourth year in a row.
Exactly. Yeah.